Thinking about working with a financial advisor and you're curious about the costs? In this video, we'll discuss what drives costs up or down and leave you with a clear understanding of what you might be paying for. What drives costs up? First are the fees. Are you paying commissions? Are you paying layered fees in addition to those commissions? What do they add up in totality? The second thing that could make your fees expensive at the firm is maybe they have outdated tech, which this means they're going to have to hire more staff than necessary because they're not leveraging technology. And lastly, some firms have prestige pricing. And what this simply means is they are charging you more just because they're a big name brand on the door. What drives the cost down in the industry? First is automation and AI. Thanks to technology, we're able to rebalance, trade, and get reporting done faster and cheaper than ever before. Independent fiduciaries, smaller boutique firms without the Wall Street overhead, can be priced much leaner. Transparency laws, thanks to them, it's much harder for financial advisors to have those hidden layers of fees. The fee-only movement's been big. This is where we remove commissions and reduce conflict of interest without any excess fees. And lastly, consumer awareness. Thanks to blogs, podcasts, and social media, people are educating themselves not to fall for these hidden fees. What makes some wealth management companies so expensive? The first thing are heavy layers of management and overhead, paid for by you, the clients. Commission-driven cultures, expensive products being pushed for advisor benefit, multi-tiered fees, advisor fee plus internal fee plus strategic partner fee, and you name it. Bundled products where insurance and annuities are wrapped with other investments at inflated pricing, legacy systems and inefficiencies. Large firms pass this inefficiency tax down to you. And lastly, confusing fee disclosures. Clients often don't realize just how much they're paying. What makes some wealth management companies inexpensive? Perhaps too inexpensive? The first is some value volume over service. Mega firms prioritize headcount over personalization and minimal advice, where you just become a number. Stripped down services, meaning some offer just investment management only, no tax, no estate, no planning depth. Minimal compliance investment, meaning they may have a compliance department, but it's very lean. And that could lead to lower costs, but it also might be a higher risk to you, the client. And lastly, cookie cutter portfolios. Yes, they're easy to manage, low service intensity and a low price, but you get what you pay for. Where do our fees fall? We're in the middle of the range, not bargain bin cheap, but not private bank expensive. We're transparent and clear. There are no hidden layers of fees. You will know what the fee is every step of the way. We're value-based, means our fees reflect holistic planning, not just the asset allocation. There are no misaligned incentives. There's no commissions, no kickbacks. Our fees are competitive with our peers, often below the big banks and in line with the boutique fiduciaries. We're very service heavy. You're paying for deep planning and not just a portfolio. We're personalized versus the mass market. Our rates reflect actual human advice, not cookie cutter models. And lastly, our fees typically range from the 1.25% to 0.5% annually, depending on the assets, complexity, and scope. If you'd like to discuss our fees on a one-on-one basis or anything else, we'd be happy to get together and show you our value proposition versus what you're currently receiving.